Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the so-called passive funds that sits within our list of 72 favourite funds, namely iShares Core UK Gilts ETF. Now this is an exchange-traded fund or ETF. It's designed to track the performance of the underlying assets and deliver that performance minus its running costs. In this case, the ETF is tracking an index which contains a range of UK government bonds, also known as gilts, which are priced in pounds and quoted on the London Stock Exchange. Do note, however, index-linked gilts don't feature in this particular benchmark. Now, the ETF uses physical replication to provide performance, so it owns the actual underlying bonds. And as I sit here, there are 42 bonds in the portfolio, which are almost entirely rated AA. This is one notch below the highest and most coveted AAA rating, and this suggests the borrower, in this case the UK government, is highly likely to pay both the coupons, or the interest on the bonds, and repay the actual loan, or principal, once the bond matures. In sum, the UK is seen as a low credit risk. In terms of the maturity of the bonds, the effective maturity is around 15.5 years. The chart shows the maturity profile of the bond holdings by range in percentage terms. Now the yield's around 1.9% and the ongoing charge figure for the ETF is just 0.2. So the good news is fees and costs do not gobble up your yield. The product's around £1.5 billion in assets under administration, so it should be pretty liquid, at least under normal market conditions, although we might come back to that in a minute. The ETF's over 11 years old and it comes with a 3-star ranking from Morningstar for those who put value in such things. So, those are the mechanics. The next question is, why would an investor consider this ETF for their portfolio today? And I think there are 3 factors to consider. The first is the low-cost, diverse portfolio. The ETF provides access to 42 different bonds at a cost of just 0.2% a year, so it saves you lots of research and lots of trouble for a modest cost. The second is the 1.9% yield. It's not much, but it beats cash, and the UK has not failed to pay interest or repay any loans, in other words default, since 1672. The third is that gilts and bonds overall are generally seen as lower risk than shares. If you buy a bonded issue and hold it to maturity, you get the interest payments, coupons, and then get your money back at the end when the bond comes to the end of its life. That's why bond funds form a staple part of many a cautious portfolio in particular. However, this is not to say the iShares Core UK Gilts ETF will suit everyone. And that may be the case even if you're a cautious investor, because there are 3 things to consider as well. First, that 1.9% yield may look too low to some investors who want a bit more, albeit in the knowledge they'll have to take more risk to get it and could therefore see the capital value, the bond or the share price, fall. Second, UK inflation is running at 2.6% based on the Consumer Price Index and about 3.5% on the Retail Price Index. That more than covers the 1.9% yield and means that holders of the ETF are taking a real terms post-inflation loss at the moment on the basis of the coupons alone. Now inflation could pull back if oil prices stay low, but remember the Bank of England inflation target's 2%, and one day, it may start to raise interest rates from the historic 0.25% low. Third, bond funds and bond trackers behave differently from individual bonds. With an individual bond, the capital risk is low and you should get your money back plus the coupons if you buy, issue and sell on maturity, providing the issuer or borrower doesn't go broke. But during the price of a bond, its price will change during its lifetime according to expectations for inflation, interest rates and the risk of bankruptcy, no matter how small. And that means the bond price rises, the yield falls and vice versa, just like a share. The example here shows the UK 10-year gilt over the past 12 months and shows how yield and price move in opposite directions. So what, you might think? But remember this, a bond fund never matures. So its price and yield will be constantly moving and its price can go down as well as up. The price could fall if inflation soars, interest rates rise or the government gets into financial trouble. The price could rise if inflation sinks, interest rates remain anchored at their lows and the UK pays down some of its record budget deficit. So to say bond funds are risk-free is not correct. There is risk associated with any investment, even cash in the bank if inflation is galloping higher. So bonds can and do fall in price, and so do bond funds, whether they're active or passive. Now normally they fall a lot less than the share price if something goes wrong, and companies get into financial trouble much more often than governments, Again, the UK's last real spot of bother came under King Charles II. This price chart for the ETF since launch shows you what I mean. You can see the occasional stumble among the broader rise. So when you do your research, you do therefore need to make sure that the returns on offer, in this case the yield in particular, are enough for you relative to the risks and fit with your overall investment strategy and time horizon. Thank you for watching, and I look forward to seeing you next time.